Regarding the economy and what happened last week when I was away, the U.S. Federal Reserve came out at their meeting last Wednesday and more or less was very hawkish, blaming some of the inflationary pressure on Trump and also blaming the reason why they cannot act right now because of the uncertainty caused by Trump's economic policies, which more or less just heightened the tension between Trump and Powell. Then on Friday, we got some U.S. job numbers where there were significant revisions over the last few months. I think it was over 800,000 downwards, which makes the economy look much weaker, the U.S. economy much weaker than it actually is. But this is the key point. The Fed did acknowledge that weaker underlying job growth is not concerning them because of the U.S.'s immigration policies right now. As long as supply of labor is decreasing at the same rate as demand for labor, they are not concerned. And because of the U.S. or the Trump administration's objective to get rid of illegal immigrants, which reduces labor supply, the U.S. Federal Reserve is not overly concerned about the reduction of over 800,000 jobs over the last number of months. What they are focused on is the unemployment rate, which is at 4.2% right now. So that kind of just, de-emphasizes the weak numbers that came out on Friday from the U.S. Moving forward, though, a key point that I'd like to make and that I read last week was some people have been pondering, why is the U.S. economy doing as well as it is given these trade conflicts that have been caused by the Trump administration? And when you look at this chart here, it shows the percentage of the U.S. tech build out for AI and what percentage of the GDP growth it captures versus all other industries, all other durable goods, I should say. And as you can see here, it more than offsets it. So the negative impact of trade conflicts on durable goods is being completely offset by the build out of AI infrastructure in the U.S. And every week we hear a new, $100 billion deal that Trump is signing regarding building new data centers with foreign countries, or, foreign countries investing in the U.S. So this is completely offsetting the negative consequences of these trade conflicts on durable goods so far. So that is why the U.S. economy is holding in there, in my belief, and this data backs it up. And you could use the same argument for other countries. Canada is obviously not near as progressive with regards to our AI build out, but we are building out AI infrastructure. Canadian companies are doing things in AI. They are spending money on R&D and AI. So again, the negative implications from these trade conflicts are pretty partially offset by the build out of AI. And the question then remains is, will this continue and get us through this rough patch, and we're actually going to see growth and no major downside, and therefore no major interest rate cuts? Or is the negative implications of trade going to offset this? So with regards to the negative effects of the trade conflicts, if they are more substantial than the positive economic effects of the AI build-out, then we will eventually see a recession and more interest rate cuts will be needed in Canada. But if it's the other, where the positive effects of AI build-out more than offset the negative effects of the trade conflict, then we may not see any more interest rate cuts from here. And that's really that's the best way to describe this economic tug-of-war that's going on between the AI build-out and the trade conflicts, and whether or not the U.S. and Canada has to cut interest rates further. Take care.